markets are constantly changing, the world's changing, there's new businesses coming through. And so I just find that really interesting to be a part of. You're constantly meeting the people behind the business, which is really important, the CEOs, the management teams, the board of directors. They're also important elements to investing, and it's actually a privilege to be able to do that. And particularly, when you find a great company and the people behind it, it's kind of, we don't view it as so much as us making the decision. It's the people running the company that do the work. Part of our job is to spot great assets and great people, put the two together, and they're the ones making the money for us.
Hello and welcome back to the Get Rich Slow podcast. I'm Tash and I'm here with Mark Freeman, who is the Managing Director for AFIC. Welcome, Mark.
Good morning, how are you?
Good, thank you. I'm going to start with your money win or money loss, and then we'll get into what you actually do at AFIC, and we're going to chat about all things LICs. So what's your money win of the week or loss?
Oh, well, the money winner was certainly, I was actually in Sydney for the weekend. I've just been to an investment conference for 2 days, but I went there before that to catch up with a friend. And I guess for me, money win was going out for dinner, but just spending time with friends. As you get older, there can be a tendency to, I guess, reduce the number of friendship groups. And there's just a huge amount of value actually in catching up with people and staying friends, but you just got to put in the effort to do it. But the rewards are there, so I really enjoy that. Plus, the other thing about catching up with that particular friend is that he listens to a lot of investing podcasts and was encouraging me to listen to a lot more. So I have been doing that, and spot on. They're great things to listen to and a great way to learn and understand about investing. So he's got me hooked. So that was certainly a money winner.
Definitely a win.
In that regard. So,
and now you can send him this one back and be like, look, here's one that I'm on now.
Absolutely, I will be.
You listen to me even more.
Yeah.
I think you said he recommended Equity Mates.
Yeah, he did. That was just one amongst a few. It's just good to hear what's going on out there and getting other views on stocks. So I think one of the important parts of being a fund manager is being prepared to listen to different views. The worst thing you can do in funds management is be fixed in terms of what your view is. You can have a particular view, but if new information comes along, you've got to be prepared to change your view, and you've got to have a strong sense of curiosity. And so getting other people's views and opinions, it doesn't matter where they come from, they all challenge your thinking. So it's all good.
Yeah, definitely. So your job title is Managing Director. Are you a funds manager?
Well, I'm technically both, but I love funds management. I love looking at companies and looking at stocks, and I like the sort of strategy behind it. I see it as more analysing business strategy more than anything, because you're trying to predict, it's not so predict, but use your experiences to find companies that have, I guess, a good chance of being successful in the long term. And to pick up a saying from one of the podcasts I've been listening to, stock prices follow earnings ultimately. So you're trying to understand, can a business win?
Mm-hmm. Do you feel like the stock prices are following earnings at the moment?
That's a good question. They do in the long run, definitely. And they always have and they always will. But certainly the human element in markets hasn't gone away. So there's still greed and fear because you're constantly crystal balling about what is a business worth. And it doesn't matter. No AI tool can tell you that. And there's so much of that greed and fear in markets. So stocks will always get pushed up to extremes. They can go too high and they can go too low. And so that element is always at play.
Yeah, I've only been investing. I've been investing for 10 years, but really paying attention for the last 5 years. So to someone like me who's a bit younger, it feels like I can't imagine a world where they'll get super low. It just feels like things just keep going up and up and up. And I know that's not sustainable.
Yeah, you've got to always look to history, and when markets are buoyant, that's what it feels like. Everything's a winner.
Yeah.
But it just doesn't turn out like that. For example, economic cycles, they call economic cycle because it's a cycle. And also sectors can go in and out of favour. You can have booms in certain sectors, which we're seeing plenty of at the moment. So I think probably the piece people are missing is valuation. And in some areas, I think it's being largely ignored, but there's never been a point in history where eventually the two connect, the stock prices and the valuations, or the connection between the stock price and what the profit growth has been. They always trend back to each other. So I think out of this period, there'll be some lessons learned.
Yeah.
But I guess that one of the other common sayings is that, when things are booming, it'll go longer and further than what you think. And so, but it doesn't mean as an investor you just sit on the sidelines. You still keep looking through the market and looking for opportunities because there are always new businesses that are coming through that will be long-term winners.
What does an investor like me, so I don't want to research things personally myself, I just want to buy and hold a few different things. What are some strategies for someone like me in a market like this where we are maybe concerned about an AI bubble or some other kind of bubbles, maybe a housing bubble at the moment, maybe not? What kind of investment should I be looking at?
Yeah, so I don't have a license to give advice. That's not what I do. I just pick stocks. But I guess some of the things that people tell us about is the extent that you have, core positions or core exposures to broad markets rather than individual stocks, and to the extent that someone has individual stocks around, I guess, a more conservatively positioned core portfolio. That's one way of sort of dissipating risk in these sort of times, is to have a more diversified exposure. You'll still be exposed to markets, but less so to individual stocks. But yeah.
How does AFIC fit into this in terms of like the market and being exposed to like the broader market? So AFIC is an LIC. What is that for people who don't know?
Yeah, so it's a listed investment company. So it's like, it's similar now to, I guess, what you call an ETF. You can buy an ETF on the market, or you could buy AFIC on the market. AFIC's a diversified portfolio. There's over 60 stocks. Our style tends to be, it's a long-term investor, so we're more focused on businesses rather than share prices. So we always ask ourselves, are we in good companies for the long term? We're not a trader as such. Look, we don't do a lot in small mining companies and gold and probably some of the more speculative areas of tech. So, there's a time and place for AFIC, but it does have similarities to an ETF because I guess one of the advantages of ETFs is they're quite low costs, no performance fees to an external manager. AFIC's the same. There's no external management group. It's internally managed. We're just employees. So AFIC's, what we call our MER or cost, is about 0.15%.
MER?
Management expense ratio. So if you look at a fee for an ETF, if it's 0.1 or 0.2, that's what we're talking about there. So it's a very similar cost, or in some cases lower than an ETF. So
yeah, just say it was 0.15.
0.15.
Yeah, that's very low compared to some of the ETFs I see at the moment. They're like 0.5 or 0.6.
Yeah, 0.15. So there's no performance fees, and so most of the returns go to the shareholders. And so, I guess I would sort of see, because it's a diversified portfolio, it gives you broad exposure to the market. But as I said, we're probably more in the less speculative areas of the market. So you can look through the portfolio. They're all generally companies that you'd know. So it gives you that broad-based exposure to markets. And then some people do a bit of trading around the edges. So when you're lining up something that gives you broad exposure, I put AFIC in that bucket because of the low cost. And then if you're sort of worried about speculative areas, then you sort of drift back to more AFIC again. I guess the other thing, though, is because we are a listed investment company, it doesn't always necessarily trade around fair value. We publish what we call the NTA. We do a weekly update, and it's quite unusual at the moment because AFIC's been trading something close to a 10% discount to fair value.
Oh, really?
Yeah, which is really unusual. So we were looking at a chart recently that goes back nearly 30 years, and generally we trade within a few percent of NTAs, but we had these periods, strangely enough, where sometimes we can trade at a large premium, and there's been a couple of times in history, now being one of them, we've traded at these sort of discounts, but it doesn't tend to stay. But
yeah, why is it a discount now?
Well, I think what we've found at the moment is that there's probably a number of things coming together. Is that we've always lagged a bit when it's a hot market, when people can find things to do themselves, and a lot of things are going up, people drift towards that. So the last time we saw a discount like this was going into 2000, before the tech wreck.
Oh, interesting.
Same thing. There's lots of hot sectors, and then once that unravelled, we sort of went back to trading more in line with the fair value. So, so I guess in this market we're in, AFIC gives you broad exposure to the market, low cost, but you can actually buy it, around, because it's sort of bobbing around a bit, but around 10% below it's actually fair value. And then what it means is that the dividend yield is actually higher than what you get if you paid fair value. We paid a special dividend just gone. So
what was that dividend?
I think it was 5 cents. I think we topped it up.
And what percentage did that work out to?
Well, the yield ended up being just over around 4.5%. Yeah, pre the franking. So when you include that, it's quite a good attractive dividend yield, and you're buying at that discount. And AFIC's also had a history of, because we're in a company structure, if we make capital gains, we do have to pay tax, but it means we create some franking credits. We tend to keep some of those for what we call a rainy day. And when we had COVID or the GRSC, we then called on those and we sustained the dividend through the tough times. And that's something that a listed investment company can do. And so stability of fully franked dividends has always been a feature of AFIC, particularly during those tough times. So there's a few interesting features about AFIC as well. Yeah.
Seems to be some interesting active involvement, because with ETFs they're quite passive, but then in your case you can kind of step in and say, oh, we'll keep some of these franking credits for those rainy days, and you have those levers to pull, which is really great.
Yeah, I guess it's been interesting at the moment because we've been taking a little bit out of our bank exposures. Now, if you buy an ETF at the moment, you basically around 25% of your money is going straight into the Australian banks. I mean, we like the Australian banks. We think they're well run. They produce some good dividends. But the point about valuation, the valuations are way above where they've been in history. But if you go into a broad-based ETF, that's what your money's going into that. But we've been actually using the strength to lighten our holdings. And so these are some of the things we can do in an LIC that are different to an ETF.
What kind of things are you buying or investing in instead of banks? Because in Australia, it feels like it's mines or banks mostly. What else are you being able to find?
No, there's certainly other companies. So over the last, more recent times, so what we would probably call ourselves, we look for value within quality companies. And so there's a number of aspects around what is a quality company. We might come back to that. But we're trying to find value. So with larger companies, you're often looking for what I'd call a price dislocation, because stocks tend to go in and out of favour. So, for example, we find Woolworths quite interesting at the moment because Coles has been doing really well. The share price has done well. It's a good business, and the Woolworths share price has sort of been sold off. But if you look through the history of those two supermarkets, there's always sort of one doing a bit better, one not so well, and they tend to take it in turns. And at the moment, sort of Woolworths has been a bit out of favour. We think it's a great network, and eventually good management will improve that situation. So it's a bit out of favour, but it's a good fundamental business. So we think businesses like that, we've been adding businesses like Telstra because we think the dividend yield's really good. We still think the growth's reasonable.
What do you think about Optus? There's a lot of people who listen who are a little bit upset about the Optus privacy and data breaches.
Yeah, well, we don't have an investment there. So the sort of data breaches we're seeing, I'd say don't be surprised if we don't see a lot more of those though, because unfortunately the cyber criminals are becoming very, very sophisticated. And it's, what we're being taught at work, you've got to make sure your own privacy is protected as much as you can, but there'll be more of these, I'm sure, going forward. So,
is that something you consider when you are looking at a business? Do you look at stuff like the privacy and data breaches as well?
Yeah, we do, because then we ask questions about, what was going on? Is the company just not investing enough in that area? Will it have a permanent impact on the business in any way, or will the market kind of see through it in the long run? Because it's not always, running business is difficult. There's always going to be something come up that challenges you. No, there's no such thing as a perfect business. So sometimes you never want to sort of say, well, I'm going to sell this stock because of an event and never invest it again. I mean, stuff happens from time to time. So you're trying to work out, is this have a permanent impact on this business or not? So they're the questions we'd be asking.
Yeah, definitely. We've got some questions from Instagram that the community sent in. We've kind of covered some of these already, but I just thought we could go through them kind of rapid fire and maybe list a few points for each. So the first one is, what are the key differences between ETFs and LICs, and where does AFIC fit in? You've already said it's listed on the stock market as well, but there are differences in terms of management. Yeah,
that's right. So, we do have an investment team. We're not active in terms of, we have very low turnover, but we are looking at our stocks the whole time. We also have a board of directors, and these are a group of people who have some really good industry experience that we tap into as well. And plus they provide that oversight on the company so people feel, safe where their money is. because being a public company with a board of directors and audited accounts, you can see where your investments are. We're very transparent. You can meet with us. You can talk with us about what's going on. So there's a few other elements that differentiate LICs.
And you've been there for 33 years, which I find very impressive because I think in today's world, there's a lot higher turnover with staff and people at businesses. Why have you stayed for so long?
Well, I've just always loved the job. I just find it fascinating working in the investment area because this idea of what creates a successful business. Are the companies putting in the building blocks to do that? Markets are constantly changing. The world's changing. There's new businesses coming through. So I just find that really interesting to be a part of. You're constantly meeting the people behind the business, which is really important, the CEOs, the management teams, the board of directors. They're also important elements to investing, and it's actually a privilege to be able to do that. And particularly, when you find a great company and the people behind it, it's kind of, we don't view it as so much as us making the decision. It's the people running the company that do the work. Part of our job is to spot great assets and great people, put the two together, but they're the ones making the money for us.
I love that you always look really happy when you talk about AFIC. You get the smile. It's really great. I love when people are passionate about their jobs.
Yeah. Well, it's a privileged position. So,
Peter Thornhill is a strong advocate for LICs. Are the reasons behind that view still relevant today, particularly in relation to AFIC?
Well, it's probably some of the things I touched on previously. It's sort of, we do take a more conservative approach to our investing, and, the costs are so low that the shareholders get the full benefits. So, I'm not a big fan of some of the managed funds that charge high fees and high performance fees. It can be good for a while, but it can also unravel. So, as I said, I would put us alongside it as an alternative to an ETF. And I guess one of those features that we touched on earlier is sometimes we do trade at a premium and that's too expensive. But when you're at this discount, it can provide a good alternative to other investment opportunities, particularly if you sort of feel like you want to put some money in, but you're a bit cautious about where markets are. So these are some of the things people need to think about.
Yeah, I'm going to have to go home and Google that discount. I think that's very exciting when I feel like all I'm hearing at the moment is how overpriced a lot of stuff is. So it's rare to hear that things are actually trading at a discount these days.
Yeah.
What strategies does AFIC suggest for managing risk when investing in shares?
We do use diversification. So we do have a spread of sectors and exposures. That would be one point. The second point is to get to know the people who are running the businesses. And you can't always control that because sometimes management teams do decisions that you scratch your head over. But the extent you can, try and stay with the people who you trust. Another point I would say is that steer towards companies that have strong balance sheets. So it's amazing how often debt can get a company into trouble. So these are elements you can do to manage risk.
Yeah, I hear that all the time with like Uber or Netflix or stuff like that, where they don't make a profit forever and ever and ever. And then all of a sudden they expect to make a profit, and you hear about it and you're like, wow, imagine if you could run your personal life like that and never ever make profits but still be kind of successful. Yeah,
well, eventually time will catch up to them. And so if a company's not profitable, it can go on for a while, but eventually the market will want to see a profit.
Yeah.
And so, you can see when the market gives up on a story, it can be pretty savage. So, let's say, up the stairs, down the escalator. So that's the risk you're running with businesses that are struggling to turn a profit. Because until they do that, it's sort of, what's the company worth? And you're really investing on a bit of hope rather than observation. So it doesn't mean you can't have some of those, but you want to see the pathway to profitability and the way it can grow, because the theme around eventually share prices will follow profits and earnings will always be there. So you want to see that come through.
Yeah, and as a consumer, it get a little bit annoying when all of a sudden everything's getting a bit more expensive. There's ads in your Netflix now for the same price, and you're just kind of seeing it all come together where now they finally want to make money back off you.
Yeah, well, that's what they do. Well, it's one of the hooks of some of these business models that we're seeing today is that it's about getting the consumers onto your product or your business and getting that to be a part of your life, and then they'll gradually introduce strategies to extract more value to create a profit. Mm-hmm. But that's businesses there to make profit. They're there to serve their shareholders, which is to create a profit. So there's nothing wrong with that. But it is a common strategy at the moment is to get the scale first and then worry about profits later. But it has been a very effective approach because often it's the company that creates that leadership position is the one that most of the profit goes to. And so there's always a battle to be the number one player in a segment or a sector, because the money will tend to flow to that. So get to the number one position, cement that, and then start to try and extract value. And it could be, if you're on Netflix, starting to charge higher fees or costs, or slightly change the service offering.
Oh, adding in ads. Yes.
Yes, that's it. Yeah.
I feel like they're all colluding. Like, I know they're all watching each other, but it's like when all of a sudden all the streaming services that have ads all in the same week pretty much. It's like, interesting.
Yeah, no, well, I think they're probably just following a similar business model where, there's a point, because you can't run an unprofitable business forever. It just doesn't work like that, because you just run out of money, run out of funding. So as I said, it's get as big as you can, but then at some point you've got to try and make some money out of it.
There's a show about the story of Uber on Stan that's really interesting. If anyone wants to go and watch that, it kind of gives you an insight to what Uber was like. It's very dramatized, but it gives you a little bit of an insight into how Uber got started and how unprofitable they were in the beginning. It's very interesting.
Yeah. So I haven't seen that, but I can imagine they're probably doing a similar path to what I've been talking about.
Yes, definitely. Yeah, definitely take over the whole market, push the taxi drivers aside, and then be like, oh no, now I need to actually make money.
Yep.
Yeah. How has AFIC performed in comparison to just like an ASX 200 ETF over the long term?
Over the long term, we're sort of similar, but we provide that consistency of dividends. I mean, the last year has been a bit tougher because I said gold stocks running, small mining stocks running, other segments running. It's not really what we do, but we've seen these cycles before. So important for us is to stick with what we do. And as I said, the test for us is, are we in good businesses that are not relying on some external factor or not relying on becoming profitable, that have clear strategies to just continue to tick along and grow their business? That's been sort of the more AFIC style over the long term.
Why doesn't AFIC invest in something like gold? Because that seems to be all of the rage at the moment. Yeah,
well, probably for that reason. Look, there's reasons why it has been strong. Central banks probably got to pretty low gold exposures over the last decade. It was more focused on US dollar. And I think probably to some of those, they probably felt that they went too far, and they're just trying to rebalance a little bit. So there's been strong central bank buying, but I'm not sure when that comes to an end. But then once you start pushing up the price, then sort of everyone wants to get on board. And I was in Sydney a few weeks ago, and there was queues around the block, people trying to buy gold. To me, there are sort of a few red flags, but there's reasons it's going to hold up for a while. But it's gold's interesting because it's not an income producing asset.
It's just a rock, pretty much.
Yeah, it's just a business. And what if you buy gold at these prices, you're just hoping that there's someone at some point in the future that is willing to buy it off you for a high price, based on whatever reason you want to give. But our focus is more on businesses that are creating wealth through the way they grow their business, grow their market, and it's more sort of sustainable in how you do that. And they'll often produce dividends, profits. There's something tangible that you can hang your hat on. But gold, where it is, it's hard to have that sort of analysis behind it. Yeah. So, sometimes you've got to realise or work out what you think you're good at and stick with that. But picking the gold price is not something I'm very good at. No,
I'm assuming you'll say the same for this next one, but what do you think about crypto?
Well, that's probably even more of a mystery to me. You're asking the wrong person about crypto, because that's one I really do struggle with, because it's something that's created by a computer, and again, it's nothing tangible about it. And if you buy it as an investment, it's the same logic, is that you're just hoping that someone will pay more for it off you at some point for some unknown reason. And there's so many of these things appearing. Yeah, I really struggle with it, and I can't see how it can be a proper form of currency for a country because of the way they're issued. And so, if people want to do it, but I'm probably the wrong person to ask.
How can younger investors block out all of this noise? If you're seeing house prices are skyrocketing and you maybe is feeling FOMO with that, gold prices are skyrocketing, and again, you might feel FOMO because you're walking down the street and you see lines around the block. You see crypto kind of skyrocketing at the same times as well. How can you block out all of that noise and buy a more boring but possibly stable investment like an AFIC or another ETF?
Yeah, well, I guess that can be a starting point, but it is harder for a younger person because there are opportunities in the market, but you've got to be looking across the broad spectrum. And so we do look across the market, and there's always something we find in any 1 year, there's always something that's falling out of favour for whatever reason. And, we've got a good holding in, say, CSL at the moment. That's been really poor over the last year or so. But there's a stock like that, you can do your research and say, well, has this fallen too far? Because, as I said before, something is working well, they can get pushed too far on the way up. And it seems like at the moment, if you're not in favour, you can get pushed too far the other way. Mm-hmm. And so that's what you're looking for, is something that's sort of a good established name where the share price has fallen. So rather than looking for the cues around the block, look for the ones that seem to be disliked in the market, and then have a think about it and say, well, what is this business? Is this going to be around for the long term? Is it servicing a need that's going to be there for the long term? And then you can sort of look at some basic evaluation metrics, even like a PE as a starting point, and find some things that have had a decent fall. Because at the end of the day, buying value, you want to be hunting for value. That's always the better way of generating long-term returns, rather than getting on board something that the FOMO, there's a big chance of being disappointed if you do that. But hunting for value within markets is proved to be a better strategy. And it doesn't mean you look for completely beaten up companies, but I'm saying you still stick with good companies.
Yeah, you're saying big ones like CSL and Woolworths, which are big name brands.
That's a good starting point. When are they presenting value? But they're still good, sound businesses. But you can move into smaller companies and mid-sized companies too. It doesn't have to be the very largest. But I always look at value as, if you're looking for a company that's emerging, is getting in early to a story, getting into late. You lose money so often if you're late to something.
How does an everyday investor find those early companies? Is it just by investing in something like AFIC, I guess?
Yeah, well, that's the hard part. You really have to be doing your research and following lots of companies to do that. And then with the larger companies, then it's more around, there's some sort of event that's creating temporary weakness, but you think, no, this is still a good company. So that's two simple frameworks of looking for value.
Yeah, I saw CBA announced what looked like quite a decent profit, but then the share price fell anyway, because apparently people didn't like something that the CEO said.
Yeah, well, this is the point around values. And so, if you look over the last 12 to 18 months, the share price has gone up probably 70%, 100%, but the profit's gone up 3%. Mm-hmm. And so you go, what's going on there? How does that happen? The shareholder base of CBA is quite sticky. There's a lot of retail investors who went in from the start, and they just don't sell, because if they do, they've got significant capital gains tax. So it means there's not a lot of selling out there. But as the company got bigger, as more money flows into ETFs
and into all the super
industry funds,
they
go, well, that's the index. I've just got to buy it. And they don't take into account, it doesn't seem to me, they take into account valuation.
How do you think that will work longer term as super funds and sovereign wealth funds get bigger and bigger and keep buying companies like that?
Well, eventually it will impact the performance, because, as I said, the profits don't support those sort of valuations. So for a long time CBA traded at a P of around 14 times, and this recent move pushed it to 28 times.
Wow. Yeah.
That's a multiple you'd normally equate to sort of a very strongly high growth stock. But their update, it looks like earnings is growing about 1%, very low single digit. And it gets to a point where the update, it's nothing wrong with the company. The company's doing a great job. It's a good business, but it's just not growing a lot. And they don't control the share price. It's the market that puts it on these lofty valuations. And as I said, you get these days of reckoning where suddenly the market says, well, hang on, this is not worth a P of 28. The yield's down to about 2.8%. And you get these sort of then sudden reactions. And so most brokers have valuations well below the current share price. So, we've been trimming some, but if, an ETF just buys it. So, as I said, there will always be a point where the market will suddenly switch and say, this is just too expensive.
How do you see that happening, though, if most people are investing through an ETF? Do you think people will just sell their ETFs, the super funds will start selling them, or it's the other investors who are actually buying directly who will have to be able to impact it? Yeah,
well, there's always some... there are always retail, there'll be some institutional investors that will say, this is just too expensive, and they'll start selling. And then you've got to look at the other side. If there's just not enough buying, because it could be, even an industry fund could say, look, I just find the Australian market too expensive. If they decide to allocate more money offshore, then they won't be buying Australia anymore. They might say, well, I might have a weighting of, I don't know what they have, 30% or 35%. And they might say, well, look, the Australian market dominated by banks, it's too expensive. We're going to go to 30. Then all of a sudden they become a seller.
Yeah.
And
then it just cascades down.
And if there's no natural buying on the other side, well, there's not much because potential buyers are saying it's too expensive, then you can get these very sudden movements in share prices and it can fall quickly the other way. So
I have a final question, a different kind of thing now. I see more and more news about private equity and how it's really hard to value things in private companies because we obviously don't have as much access as public listed companies. Where do you see that kind of going in the future, or do you think that's something to worry about or something that's very exciting?
Yeah, so there's probably a couple of things. So there's been a lot of commentary about private debt, which worries me a bit. Yes, I've been paying attention to, I was reading the Big Short book very recently. Oh, good. Yes. Yeah. No, actually, reading books is really, I find it's really important. So if you want to learn a lot about investing, there's some quite famous investing books where you learn a lot. And it's probably 3 or 4 books that I've read 3 or 4 times.
What's your top recommendation?
Well, the old classic is one called One Up on Wall Street, which gives you some great insights in how you should think about companies to look at. So that's a really good one.
Yeah.
So maybe start with that. And often if you go into an online book, it will then connect you to other books. Mm-hmm. So that's a good starting point. So.
Yeah, the Big Short was very interesting because there is a lot of not quite exactly the same. There's a little bit of similarities popping up where it's interesting what they're doing behind the scenes with debt where people can't quite see
what's going on there. Yeah. That's always a worry. And particularly when, with private debt, there's just been such a flood of money that go into it. And that's when you worry. You go, well, when you see so many of these private debt funds and groups getting into it, it can be quite concerning. And particularly when you've had a period of good economic growth and there's not many blow-ups, people sort of think, oh, this is all right, we'll keep doing it. But it's a sort of area, though, when something goes wrong, it can be quite significant. So private equity is interesting. Private equity's probably struggled a little bit more recently in trying to get a lot of deals because stock prices are so expensive. Yeah, but we don't really do anything in that area.
No. You guys kind of really fit our podcast because we're called the Get Rich Slow Club, and it seems to be your investing philosophy as well. Buy and hold good companies and just wait out all the noise.
Yep, that's pretty much it.
Amazing. If people want to learn more about AFIC or they're interested in finding out more information, where should they go?
Well, we've got a website you can visit. So that's got a lot of information. It's got, I think, a few videos on there. We put out a weekly NTA to the stock exchange. It will come up on our website. What does NTA
stand for?
Well, that's net tangible asset backing. Mm-hmm. So that's essentially what the portfolio is worth in a per share basis. Mm-hmm. So then you could say, okay, well, that's the value of the portfolio. What's the share price? And you can compare the two. And that's where you get the difference, the sort of 10% discount. You can say, well, that's the NTA. Mm-hmm. Well, but the share price, so the NTA has been over $8 more recently, but the share price has been around $7.30, $7.40. So that's that gap.
Mm-hmm. So you do that every week?
Yes, that's right. Yeah, it comes out Mondays.
Perfect. We'll get excited for next Monday. Thanks so much for joining us.
Thank you.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests or me at Ana Cristina.
The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invests and Ana Cristina from Perla. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you. This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging.